I believe kind of where we are right now is we're climbing this little spike here, people moving into gold as a safe kind of defensive play. This was the 2008 financial crisis. Bear markets pull most assets lower because of panic, forced selling, people going broke, needing to raise capital. I think we'll see gold pull back. And then I think when the bottom comes in, it'll be off to 3,000, 5,000, whatever. It'll start this next massive run. And it'll be interesting to see what cryptos do at this time during this phase as well.
Yeah.
So I really like gold. Short term, I like it. Long term, I like it. Intermediate term, over the next 12 months, it might be a rough ride.
The gold market may be stagnant now, but it is expected to rise significantly as the Federal Reserve cuts interest rates later this year and increasing debt fuels economic uncertainty. According to a Bank of America report published Monday, Michael Whitmer, the bank's commodity strategist, sees the potential for gold prices to hit $3,000 an ounce in the next 12 to 18 months. ChrisVermeulen, chief market strategist of the technicaltraders.com, also has a bullish long-term outlook for gold and silver, drawing parallels to the 2008 financial crisis. Vermeulen notes that gold initially dropped due to panic selling but then surged, and he anticipates it could reach up to $5,000 in the long term, igniting another massive run. In the short term, Vermeulen predicts an impending recession and stock market downturn that might pull gold and silver back, presenting buying opportunities. Gold and silver prices have continued to trade at similar levels throughout June, with market volatility driven by various factors. Since pulling back from record highs at the end of May, gold has traded in a tight range of $2,300 to $2,350. Despite this, Vermeulen believes precious metals will eventually surge. He expects mining stocks to rise, signaling the start of a potential 5 to 10-year rally for gold reminiscent of the 2011 to 2012 period. However, the World Gold Council reports that the gold mining industry is struggling to sustain production growth as deposits become more challenging to find, with mine production increasing only 0.5% in 2023 compared to the previous year. Furthermore, the increase in stocks could further bolster gold prices in the long term. In addition to gold, Vermeulen also favors the US dollar index, which he predicts could potentially hit 120 or higher. While the dollar trades sideways for now, he anticipates it will surge amidst market chaos, temporarily pulling gold down. Once the dollar peaks and the crisis eases, he predicts gold will rally and the dollar will decline. Now, we present clips of Chris Vermeulen's insights from his recent interview with David Lin. Before we continue, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I mean, on gold, I'm bullish on gold and silver longer term. I do think there's going to be a bit of a rougher ride in them going forward as we see the stock market and I think a recession hit. I think they'll get pulled back a little bit, but I still really like gold and silver. They've built beautiful chart patterns. When we look at the chart of gold, it's been, a rally, a pullback, a rally, a pullback, multiple bull flag patterns. I still think we're going to see gold hit 2650, 2750, 2750 in the next month or two. So I like those. I do think they're going to pull back with the market correction. I don't know where they might pull back to. I think you could probably buy gold at the price it's at right now, or maybe actually a little bit lower, 6, 8, 12 months from now. So, and when that opportunity comes around, we'll probably also start seeing mining stocks really start to come to life. And that to me will be like, okay, now gold will be off to the races for what I think will be like a 5, 6, 10-year rally, a lot like we saw, let me go way back here, back going into 2011, 12. I think we could see multi-year run after this. I believe kind of where we are right now is we're climbing this little spike here, people moving into gold as a safe kind of defensive play. This was the 2008 financial crisis. Bear markets pull most assets lower because of panic, forced selling, people going broke, needing to raise capital. I think we'll see gold pull back. And then I think when the bottom comes in, it'll be off to 3,000, 5,000, whatever. It'll start this next massive run. And it'll be interesting to see what cryptos do at this time during this phase as well.
Yeah.
So I really like gold. Short term, I like it. Long term, I like it. Intermediate term, over the next 12 months, it might be a rough ride. So those are the three time frames. But I really like this, and other than that, I mean, I like the U.S. dollar index as well. So I think when the stock market is selling down, we'll see gold sell off as well. And during that time, I think we're going to see the U.S. dollar scream to the upside. The dollar to me is in this very strong pattern, and I think it's going to go up to about 120, if not even higher than that. So I think the dollar will be a very good play while the world is falling apart. The US dollar index tends to do very well. It had a huge rally in 2008. It had a massive rally going into the financial tech bubble. It pushed up. And I believe we're going to have another crisis, and it's going to push back up and probably get up to these lofty levels. So the nice thing about the dollar index is low volatility. I mean, it rallied like 18% in 2022.
Yeah.
Biggest pullback was less than 4% along that move. So very slow moving. Nothing in there should have scared the crap out of you. You just ride that trend. And I think we're going to see something like that again. So those are the two assets that I like. They're both going to perform a bit different at different times. The dollar's still trading sideways. It might struggle for several more months while gold moves higher. And then eventually chaos hits, the dollar will rocket. The chaos will pull gold down temporarily until the dollar tops out and the chaos comes to an end, and then things will change. Gold rallies, dollar collapses. So there's a lot of things I think that could unfold.
ChrisVermeulen foresees substantial challenges in the banking sector, foreseeing declining share prices that could prompt the Federal Reserve to lower interest rates. He views this downturn as akin to past real estate recoveries. Additionally, other market commentators, including billionaire investor Barry Stern, have cautioned about further banking instability amid persistent high borrowing costs. Stern's projections even suggest the possibility of weekly banking failures in the U.S., exacerbated by the impact of elevated interest rates on commercial property loans. Observing these trends, many market analysts highlight the potential for significant disruptions in banking, which could eventually yield investment opportunities. Shifting focus to the housing market, Vermeulen anticipates that despite enduring low fixed mortgage rates, many Americans will grapple with mortgage payments due to job losses and diminished savings. He predicts this could lead to considerable volatility in real estate prices, akin to the rebound observed post the 2008 financial crisis. Let's get back to the interview.
Oh, they're going to get hit real hard. I think they're going to see the share prices fall down, earnings are going to collapse, and then of course interest rates will eventually start getting cut from the Fed as blood hits the streets, and they need to try and lower rates to save people, save investors, and we're going to see the banking system get hit very, very hard. It's an opportunity. Short term, it's going to be painful for a lot of people, but it is an opportunity. My dad was huge into real estate. He had over about 1,500 units at one point. And he gave me a box of his real estate stuff. And he literally had banks, this was like 20 plus years ago, send him and call him packages saying, here's an apartment building, like, give us an offer. And so him and his partners would go and buy apartment buildings out in Edmonton and Calgary and all these places for like 25 grand a unit, and they'd buy multi-hundred units, and then there'd be a rebound and they'd sell them for like 75 grand a unit type thing, the whole building. So these are opportunities, but the banks are going to get hit, share prices are going to get hit. I believe most equities are going to crash, and a lot of assets as well, real estate and commodities. There's going to be a lot of selling. So this is an opportunity, but for those who are over leveraged and just piled in and bought a lot of properties at these, what I believe, lofty pricing, it's going to be very painful. They're going to have to hold through it if they want to and be able to service the debt when things get tough. It's not the same. Mortgage rates they get locked in for like 20, 30 years in the States, but the problem really isn't so much the reoccurring or the change in mortgage rates so much. The problem is in people, their psychology. They buy a house that's beyond their limits. If things get tough or if they lose their job, they're not going to be able to pay for it. And that's kind of one of the problems. Like, we're just starting to see unemployment cross above the 24-month moving average. Almost every time we have one of these red lines, these periods, we go into some type of financial crisis, and people just can't afford their mortgages. Everybody always buys a house that has it's a little outside of their range. And as soon as one of the homeowners, one of the couples or somebody loses a job, It doesn't take long for people to burn through their cash.
Yeah.
I mean, I think I heard a stat just last week that 70 or 71% of Americans are living paycheck to paycheck, or have, I can't remember what it was, something like that. It's a lot.
Well,
Real estate, or people's savings is now below COVID. People have burnt through all their capital. The U.S. doesn't have mortgages renewing in 3 or 5 years. It's like 30 years. The problem is times get tough. People can't afford the mortgages because they run out of money. And a perfect example is a property that we had looked at in Florida. We go to Florida every year. We've got a place there. They wanted 550 grand for this little tiny place by the water. And after the financial crisis, 2008, my parents ended up buying one for like $178,000. And now it's valued at over $1 million.
When was this? How many years ago was this?
This was 2007 to like 2012 window. It went from 550 to 178, and now it's back up over $1 million.
As we look forward, gold and silver appear poised for a significant surge. With the Federal Reserve expected to cut interest rates and economic uncertainty increasing, there's a strong possibility that gold could reach remarkable new highs in the coming year. What are your thoughts on these forecasts? And how do you plan to capitalize on these potential market shifts? Feel free to share your insights in the comments section. If you found this video informative, remember to subscribe to our channel and enable notifications to stay updated on our latest content. See you in the next video.